Welcome back to Market on Close. Stocks are trying to hang on for the ride here after getting a little bit topsy-turvy when Powell started speaking. We've still got tech working. Bonds are rallying big right now. So there goes your 4% yield. Barry Martin joins us, portfolio manager at Shelton Capital Management and head of option strategies. Barry, welcome back to the show.
Thanks, Oliver. Appreciate you having us on.
Hey, how much does this change the game, seeing yields dive like this when it seemed like a lot of stock pickers, portfolio managers, and just everyday folks were pretty happy to get 4% on their bonds a couple weeks back? Does this change the game?
Well, not really. I always live by the additive of, you don't want to fight the Fed. And so if you're looking for an equity strategy, what we're doing is cover call writing, selling away the upside, and generating cash flows. Right now, even though Treasury yields are where they're at, volatility is still elevated. And so when you're selling covered calls, what you're doing is monetizing volatility. So we're generating additional cash returns by monetizing the volatility on these individual equities, and we do it by selling covered calls. So currently, right now, we're selling options that are 45 to 60 days out that have about 8 to 9% upside that are annualizing about 9% in option premium. And that does not include the dividend yield. So you also own the dividend yield as well. So we're seeing a lot of cash flow and income out there because where volatility is and where the VIX is.
Now, this is the strategy in the fund EQTIX, or is this something you overlay across different types of strategies?
Correct. So this is the main strategy of our equity income fund. Once again, the symbol is EQTIX. And it's in a category on Morningstar called derivative income. And so what we're basically doing is selling individual calls on individual positions throughout the whole portfolio. So we have roughly about 100 holdings where we're selling away these options and selling away the upside, but generating those cash returns and putting it into the client's pocket and paying it out on a quarterly basis.
Got it. Is this something that you put in as part of the stock side, or can this replace bonds, especially if yields keep going back down?
It performs differently. It performs differently than equities, and it performs differently than fixed income. So you have similar market returns with about 25 to 30% less standard deviation, but then also you don't have the interest rate risk over on the fixed income side. So it's a new return pattern adding to one's portfolio. So you're lowering the overall risk of a client's portfolio. So we're seeing it used in multiple different ways. But still, people at the end of the day use it as an alternative income strategy because of the cash flow that we're generating from selling the covered calls.
And you're not necessarily doing it on the broad market, right? You're picking specific companies here?
Yeah, exactly. So what we believe we're doing is picking the best stocks in the S&P 500 to sell covered calls on. We look at a couple things, mainly fundamental analysis, but also we look at expectations of yield. And that means the dividend that's being paid and also what we can generate from selling the vol. In regards to fundamental analysis, I think it's important to focus when you're selling covered calls. It's important to focus on the quality of the company. You don't want to necessarily sell covered calls on a high flyer because you want that upside. Mm-hmm. When you're selling covered calls, you have asymmetric returns. So you're capped on the upside, and you have a lot of downside risk. So you have to pay attention to the downside risk. So you want to own quality names, names that generate free cash flow, names that have lower debt ratios, and those are the types of stocks that we own. And those are stocks that we sell covered calls on. We've had really good performance. We've outperformed our benchmark, which is the buy rate index, which is the S&P 500, with index calls written against it for 5 consecutive years. So again, what we're doing is buying the best stocks in the S&P 500 to sell covered calls on.
And Apple plays a role in that as a steady grinder, basically. That's kind of what you're looking for, the turtles that go in the right direction?
Yeah, exactly. Apple's, quality name. It's a name that mom and dad knows, and it has enough volatility on there where you can generate sizable premium. Right now, with a price at about 160, you can sell let's say the May 170s and get roughly about $2.73. So on that, when you're looking at that, that's about 1.37% in yield. And this is over 60 days. So if you continually do this trade every 60 days, you can take that money, put it in your pocket. Obviously, if the stock appreciates, you want that too as well because you own the underlying equity. So if you're buying it at 157, 160, where it is now, 160, stock goes to 170, you're adding that $2.73. Your cost basis, or where your your cap is at 172.73, and that's 8% appreciation plus another 2% in the dividend and the option premium. So we'll take that trade every day. But if it never gets there and the Fed continues to raise rates, what we're doing is, again, selling away that upside, and we're taking that profit that we're generating income for generating those gains, and then you pay it out to the client.
Got it. All right. Thanks for the walkthrough, keeping us focused on some strategies here on a day where it's easy to get distracted. Thanks a lot, Barry.
Thanks, Oliver. Take care.